I'll tell you some of the difficult topics generally you will not have, because from inter in the articleship you will see different experience, and when you come to the final there are some topics which are not related to what you studied before. Okay, in that one of them is derivatives. You will not do debt securitization. You will not do it. Those are difficult topics. So I will just start an introduction of derivatives, what all derivatives, why it is used, and how do we calculate derivatives. Okay, it's very easy. Generally, people think that is a toughest topic in this one, but I don't feel it's a very tough topic. Okay, now what do you mean by derivatives? Where it is used? Derivatives. Okay, we call derivatives. You know what is share market is. You know what is shares. You have seen what is debt. Shares and debt you already know what it is. Okay, these are sources of funds. Shares is a source of fund, debt is also a source of fund for you. Okay, and you know how to calculate the value of equity shares and how to calculate the value of debt. Then where does this derivatives fit? Derivatives in financial management fit. It is used for three things. The main importance of derivatives is it is an hedging tool. What it is? It is an hedging tool. We call it as an hedging tool. What is hedging? I will tell you. It is an hedging tool. Same way it is used by few people as a speculative tool or speculation by speculators. It is a speculative tool. Okay. First hedging and speculative, then third one I'll tell you. First you understand these two, then you will understand the third one importance also. Okay. For example, I am a trader, I have a restaurant. I buy a lot of products from the farmer. Okay. I know the price of rice today is 1,000 rupees. Tomorrow I am expecting that price to rise and it becomes 1,300, but I cannot increase my menu price. No? So what I will do to lock the price, I will enter an agreement with the farmer saying that I will buy the rice tomorrow also at the same rate, 1,000 rupees. Okay. Now, so that is what hedging tool. Hedging means it will help you to lock the prices so that tomorrow if there is a risk of price rise or a price fall, you will not feel that loss. That is where the derivatives comes from. Okay. Yeah. Yes, correct. So what are different types of derivatives? I'll come to it. There are forwards, futures, options, swaps. Okay, clear? Forward contracts, I'll tell you those differences also. So everything derivative, the word derivative has come from, there is an underlying asset to it. Here the rice price is an underlying asset for me. On that underlying asset, I will decide my derivative price. Okay. There are derivatives based on index. Index means Nifty, Sensex index. That means market sentiment. I will expect what is tomorrow's India's business sentiment. Where it will reflect in Nifty. So I will speculate on Nifty. So I will do derivatives on Nifty. Tomorrow HDFC stock price I am interested in. I will do derivatives on derivative stock price. I can do derivatives on weather also. Why weather is important? Tomorrow rain will fall or it will not fall. That is also a derivative. I can do that. People call this one as a betting. It is not betting. Betting is just generally a lot of people say this is a betting, it should be illegal. Derivative is not a betting, it's a hedging tool. Why weather is important? For farmer it is important, it may not be important for you. For farmer it is important. Tomorrow rains comes, then I can do production. Tomorrow rain doesn't come, who will give me guarantee to it? It's like an insurance. So he'll buy a derivative tool and keep it. Tomorrow rain doesn't fall, derivative will give me money. Tomorrow rain falls, what will happen? I can get money from the crops. So derivatives helps as an hedging tool for me. Okay, same way speculators will be there. There are people who are in the market who speculate this one. Speculators also use derivatives. What they do, for example, I am not in business of any rice or something, but I speculate that tomorrow it will go. Okay, so what I will do, I will buy a derivative which I assume that it will rise tomorrow. Okay, then what is speculators' role? Why are they important? Because opposite of hedging, opposite of him, somebody should be contrary helping this hedger. No? Who will help that hedger? The speculator will help that hedger. Where hedging person will think that price will rise, speculator will think that price will rise down. These both people will enter into a contract. If price really rises, he will be in the profit. If price really falls, he will be in the profit. So that is why the speculator is there in the market. Is this clear to you? Other than this, there is another type of people in the market who are called arbitrage, who take that arbitrage opportunity. Arbitrage opportunity means if there is any differences in the market, I buy from NSE and sell it in BSE. Did you understand? In Hyderabad, rice is less. I will take it and sell it in Bangalore where the price is more. It is an arbitrage opportunity for me. Okay. Arbitrage comes when market doesn't have clarity about the product. That is where the arbitrage comes. This is clear to you. So we will do calculation on arbitrage, hedging as well as speculative. Is this clear to you? Now, as she said, what are the different types of derivatives? Now we'll come to the different types of derivatives. One is futures, forwards, options, swaps. Forwards and futures, the way they work both are same, but forward is not over the counter, futures is over the counter. Okay, what do you mean by over the counter? Forward, I and you can enter into an agreement, say that tomorrow I can take. Is there any mediator for us? You can default, I can also default. Can anybody giving guarantee to it? No. But futures, somebody will give guarantee to me. Who will give? National Stock Exchange will give, or Bombay Stock Exchange will give. Those are called futures. Understood this one? Now, I and farmer, person A is a restaurant person, person B is a farmer. Okay, he will buy a future contract from farmer. He will say that on March 30th, I will buy 1,000 rupees 1 quintal rice. Okay. Tomorrow, if it goes up, who is in loss? Who is in loss? The farmer is in loss because the price has become 1,300, but he has agreed to give it for 1,000. Who is in profit? The restaurant is in profit. The restaurant person is in profit. It is a future contract. Okay. This future contract is called a long contract. What it is called? Long contract. Why long contract? Long contract is something I will say that I will buy tomorrow is called long contract. I will sell tomorrow is called short contract. Okay. Now for restaurant person, what it is? It is a long contract. For this person, it is a short contract. Okay. Long and short. It is called long and short. When you will do long contract, you will do long contract when the prices are increasing. Why? Because you are locking the price and the real market price goes up. You will get the difference on how much profit this restaurant person 300 rupees. That is the advantage of long contract. Short contract, when this person expects that it goes to 900, if it becomes short, so how much loss he incurred? 100 rupees loss he incurred. Why? Because 1,000 rupees it is. Okay. Tomorrow I see rice price is going down. I will tell a restaurant person, I am a farmer, I will tell restaurant person, I will sell it for 1,000 rupees. But tomorrow rice has come down to 800 rupees. Is not farmer profit, is in profit now? Because the real price is how much? 800 rupees. Is this clear to you? That is called short. Short is I will sell for 1,000 rupees is short. I will buy for 1,000 rupees is called long. Did you understand? Okay. Now how these value of futures and forwards are calculated? They are simply calculated with compound interest formula. They are simply calculated with what? Compound interest formula. What is compound interest? Everybody knows. The present rice prices are, let us say. Okay. After 1 month it is. Some rate of interest will be there. Let us say small r. Rate of interest r by 100. After 1 month. Okay. This has to be the actual price. For example, 100,000 rupees is the rice price now. 1 plus 10% it is going to increase next month. So it has to be how much? 1,100. Okay. If it increases, it has to be how much? 1,100. Okay. So I will agree with the farmer that 1,100 rupees I will buy tomorrow. Okay. But price really raised in the market 1,200. So 100 rupees profit still he has. Okay. So here where arbitrage person will come. Arbitrage person will see that you are a layman, you only calculated with compound interest. There are other things also, market sentiment. There are other things also on dividends. Some things will be there which will give more value than the compound, just an interest. This is an interest I am calculating. Other than this, something else will be there. No? Yes or no? That is where the arbitrage person will come and see there is an opportunity. He will immediately enter this contract. He knows it will go to 1,200. He will take this 100 rupees and go out. That is called arbitrage person. Okay. Now speculator will be there. Speculator also does the same thing. He knows that you did something wrong in the calculation. That 100 rupees he will take and go. That is called speculation. So derivatives are used for hedging, speculation as well as arbitrage. Okay. Now first in the first step we will see interest we will calculate. Slowly we will do. Will you add dividend or you subtract dividend? Will you add dividend or subtract dividend? Just think and tell me. Will you add dividend or subtract dividend? Now interest rate you added. Did you add? That's why it went 1,000 rupees to 1,100. Now what you will do with the dividend? You will add or subtract? I will subtract it. Why? Because the person who is holding that asset will get dividend, no? In the future, he will not get, the farmer is holding rice now, he will get the dividend. Will he get the dividend? No. So who is in the profit? This person. He will say, deduct that price and give it to me. You already got dividend for it. Okay. For example, share price is 1000 rupees today. You are holding a 1000 rupees share price, and for that 100 rupees you got dividend. You got 100 rupees dividend. What will I do? Now, while I am buying share from you, I will tell you already got 100 rupees in your account. Give that share price for me 900 rupees. Why will I buy for 1000 rupees? Yes or no? So share value will come down. Same way, here also the futures price will come down if I am giving a dividend. So I will remove that dividend from it. Okay. Slowly like that, after dividend, what all things we will add, we will see in the further of this topic. Now, what is an option? Option is also like same futures and forwards, but option there is no obligation for me. Here I have an obligation to do. Okay. Here option does not have an obligation. For example, tomorrow I expected that it will go to 1300. It did not go. It went to 900. Restaurant person will say that I don't want to execute this contract. He can come out. Did you understand this one? Clear? He has an right to come out. He need not execute that. Is this clear? Only when it goes up he can execute. It comes down, he need not execute. Now you will ask natural question. That means this fellow has a disadvantage. No? That is what you will ask. He doesn't have disadvantage. Why? Because to execute that contract, he will pay some premium to him. Premium 100 rupees premium or something he will pay. Okay. Clear? Tomorrow, if the price goes up, it became 300 rupees. He will execute it. He will get what? That premium he will get. Did you understand this one? Okay. So he will have that premium. For that premium, he is taking that chance. Is this clear to you? So that is what option. Long and short both have obligation. In option, only one person has an obligation, other person need not have obligation. To hold this obligation, he will pay this premium. How to calculate this premium? Again, time value of money. With the time value of money, I will calculate the premium of the option. Is this clear? Now swaps. Swaps means one product, one restaurant will think the prices of rice will go. Another restaurant, I am not swapping with the farmer now. Another restaurant will think rice price will come down. So I will swap here. You are thinking anyway rice will come down. You buy with that price and give it to me. Did you understand this one? So swapping will happen. This is called swapping. This is also a tool of derivatives. Is this clear to you? Now did you understand why the purpose of derivative is? Derivative is to hedge my risk. I know returns is going to come, but risk also is unlimited to me. To hedge that one, I will keep that one. So that's why the graph of derivatives will be, if you use a derivative tool, generally the risk is higher, okay, and the returns also will fall. Sorry, returns is higher, risk also is higher. To hedge that one, hedge means what? I am cutting down, this is the returns graph now. Returns will fall, it can fall to the unlimited one. So what I will do, I'll cut this part. Now my risk was only this much, but returns is unlimited. Is this clear to you? Returns is unlimited, my risk is only this much. Why? Because I did hedging. Is this clear to you? Okay. To understand from the speculator's perspective, tomorrow you will think that HDFC Bank share will go up to 14, from today 1400 to 1500 it will go. So you will buy a futures contract of 1400. Tomorrow it went to 1500. So what you will do? You will buy it from the spot market and sell it in the futures market. Understand the vocabulary. What did I tell? Buy it from the spot market and sell it in the in the spot market. How much I am getting it for? 1500 I am getting it. In futures market, how much did I sell it for? 1400. Because I locked the price in futures market. Did you understand? 100 rupees difference that speculator will take. Did you understand? So this is the use of derivatives. In this chapter, we are going to discuss how do we calculate that futures, forward, options and swaps prices. Okay, this is what we are going to do. Okay. Other than this, in AFM, what all other topics we have? We have debt securitization. On bonds we have. Okay, international financing we have. Forex we have. Okay, from group 2 chapters in FM, you have capital budgeting, which you have discussed. That capital budgeting is there in this also. Advanced capital budgeting you will see. Capital budgeting means how much capital you will allocate for your projects. How do you calculate that one? That chapter is there. That is a long chapter, but anyway, in group 2 you studied. It will be easy for you. Okay, new things will be this one. Other than this, startup finance is there, which is a very new topic. Recently it was introduced. Startup finance means how a startup funding should happen. How do you calculate a startup risk and return? That we will see. So this is the categories in advanced financial management. Okay, clear?